Hey investor friends, I'm Michelle Markey, and today I'm going to explain the definitions of stocks, bonds, index, and mutual funds, ETFs, and give you an overview and also deep dive a little bit into some of the things I look for if I were to invest in something like index funds. So to start off, a security is a negotiable financial instrument that can take two forms typically. You can have a security in equity, known as a stock, or you can have a security in debt, also known as a bond. And commonly, companies or the US government issue bonds to raise money, and that's what's called a debt. So by issuing bonds, they're giving people a piece of the debt of a company, or in the United States government's case, a piece of the government's debt. And bonds are like an IOU, where the bond issuer agrees to pay you, the person they're borrowing money from, an interest rate, or also known as a coupon rate, until the maturity date of the bond, where the face value of the bond can be redeemed. So for example, let's take the 1980s, where US savings bonds were really trendy because interest rates were relatively high back then. And if you bought a 30-year US savings bond and had a coupon rate of about 7 to 8%, that could have been very attractive because you could have realized if you bought, say, $1,000 US bond, over the course of 30 years, you paid initially a much lower amount on that $1,000, but you earned interest payments of, let's say, 7 to 8% per year until that maturity. So if you bought a bond in the mid-80s and you redeemed it in the mid-2010s after 30 years, you could have generated a significant return on that kind of bond. Bonds from the US government or corporate bonds tend to be considered fixed income because you usually have an idea of the interest rate that you'll get and a fixed term on the bond. So if you go further out in time, say 20 or 30 years, the yield or interest rate that you get on bonds tends to be higher to compensate you for the longer amount of time that you're technically risking your money and that you risk not getting paid back. But the risk tends to be a little bit lower with the US government because it still maintains its trust among the people that it issues bonds to, and it generally pays its debts. So if you have a US savings bond, it's pretty low risk, but if you have corporate bonds, or if you're investing in bond ETFs, let's say, that can be a little trickier because corporate bonds can be liquid sometimes, which means the ability to cash out of a bond if you need to, which means liquidity is how quickly you can convert the asset into cash. So if a bond is illiquid, that means that it can be a little bit more difficult to convert it to cash in an emergency because there aren't always people who are in the market for bonds. Sometimes, even if issued by the same entity, they have different maturity rates, coupon rates, and other terms that make them a little bit more difficult to sell. And contrast this with stocks, which tend to have higher volumes of trading going on, and therefore it's a little bit easier to sell back a stock or buy a stock if you're in the market for one. And something to consider if you're thinking about buying bonds, bond prices move inversely to bond yields. So if prices are going down on a bond, that means the yield is going up. And in the case of, say, some corporate ETFs, you could buy some bond ETFs that have high yields, but you notice the price is relatively low compared to other kinds of ETFs, let's say, that have lower yields but higher prices. That can sometimes be a warning sign because it means that even institutional investors or other retail investors are a little bit unsure as to whether corporate bonds that have high yield rates will really be able to pay back their debt. And sometimes they can be considered not investment grade bonds if it has a high yield. So high yields can be something like anything from 6 to 10% of interest rates. Personally, I don't really try to invest in bonds because the yields are really low nowadays in 2020, and I may have only had bonds because, say, my parents gave me a US savings bond when I was little, or in some target index funds, a brokerage firm has decided to allocate some small percentage to bonds. But normally I try to stay away from bonds because I feel like they're just not worth it. So I tend to stick with stocks personally. But in the past, I've also invested in some index funds, which are a form of mutual funds. And to explain some of that beforehand, you need to know what a stock is. So a stock is a security that is a share or part ownership of a company. And some people tend to think of these things as a certificate of paper, and historically they used to be in that format, but nowadays with everything being digital, you don't really have to get that. And I want to stress that stocks shouldn't be just considered certificates of paper, not for a second, because as an owner of a stock, you have to imagine that you actually own the company, even though you might only own a small slice of it. But you have to value a stock as though it's your own business, because it's a growing, living entity, and it can generate cash flow that can be beneficial to your personal investments. So a lot of people tend to think of stocks like they can just trade them, and I want to reiterate that that's not considered investing. If you invest in a company and want to do it long term, like Warren Buffett and Charlie Munger, you're in it for the long haul. And they've done this with their companies in Berkshire Hathaway. They own them for many decades, and they've been rewarded handsomely for considering businesses that they invest in as businesses they own. And some of them they actually do own, while others they're just invested in, like Apple or Coca-Cola. Stocks are sold on a stock market exchange like the New York Stock Exchange or the NASDAQ. And this brings me to the beginning of the conversation about ETFs, index and mutual funds. So ETFs are a basket of securities that are also traded on the open market exchanges. And you can buy an ETF just like you would a stock. And contrast this with an index or mutual fund, of which an index fund is a class of mutual fund. These are pools of investments, usually of stocks, and they can also comprise of bonds, but they're usually a bunch of stocks. And I'll get into a little bit more of an example with regard to S&P 500 funds and ETFs that you could be part of. But an index fund tends to be considered passive, as it tracks a benchmark such as the S&P 500 or Russell 2000, while a mutual fund is considered actively managed by professionals. Both mutual and index funds have been around since the early 70s, while exchange-traded funds or ETFs came about in the early 90s. And index funds have been popularized over the years by Jack Bogle of Vanguard because they offer low expense ratios to having investments in these kinds of funds. And there was a rise of mutual funds back in the 80s and 90s because active money managers were able to garner a lot of assets under management, and some had really good results. So it led a lot of people to think that they could earn and generate a lot of investment returns by investing in mutual funds. But when a lot of people realize that actively managed mutual funds tend to charge people 1 to 2% of the assets under management, that can add up to be a lot of money over time that the end investor client doesn't receive. So for example, imagine you invested $10,000 in a mutual fund that performed at average market returns of 7%. But throughout that, the money manager actively managing this asset under management would charge you 1 to 2% of that $10,000 grown at 7%, let's say over 10 years. So at the end of 10 years, you would have had 9% less returns if you paid 1% to that money manager, and you'd have 17% less of an investment after paying 2% to the money manager over that course of time. So it just goes to show mutual funds lost a lot of popularity starting probably in the 2000s, and over the last 20 years we've seen a large increase in popularity of what's considered passive index funds, where you can have a person or a bot just track the market index. So let's say the S&P 500, and that has very low expense ratios compared to traditional mutual funds. And some of these expense ratios are so low these days that they can range in the 0.03% or lower amount. And I'll show you some of these soon. So compared to mutual funds, passive index funds can follow the performance of a popular benchmark like the S&P 500, and even news like CNBC has shown that active money managers have trailed the passive indexes that are just following the S&P 500. And it's definitely a win for passive index funds, which, unlike the actively managed mutual funds, don't charge a load or transaction fee. And historically, common brokerage firms used to show this as a no-load fund where you don't have to pay a transaction fee up front, compared to mutual funds where you do have front-loaded fees often, that it's a price you pay to gain entry to investing in that fund. So with the advent of passive index funds triumphing over actively managed mutual funds, where it shows the professionals aren't always the best at picking stocks and therefore don't always generate as great of returns, unlike a passive index, you can feel more reassured with trying to get on the passive index bandwagon. And if you want to consider an ETF in lieu of a passive index, they're very similar, but some of the differences, like I briefly mentioned before, include how an ETF is exchanged like a stock. So you actually do pay a transaction fee or a commission when you buy into an ETF, whereas with an index fund or mutual fund, you usually have a minimum amount that you need to invest, but a lot of these don't have any load transaction fees. So good news with index funds, you could invest in as low as $2,500 up to $10,000 at minimum with some of the funds, while ETFs, which can also comprise of similar stocks in the fund, often don't have a minimum that you need to invest in, but you have a trading commission for buying into an ETF. The S&P 500, or also known as the Standard & Poor's 500, is a capitalization-weighted index of the 500 biggest public American companies across different industries. So you can also think of it as a large cap or large capitalization of equities represented in this index of about 500 companies or stocks. And sometimes in some of the funds, you'll see it be a little bit higher, like 506, 508 stocks, because those will represent if there are different classes of the same stock, like take Google, which has both GOOG and GOOGL as classes of its stock. And if you do decide to invest in an index fund or an ETF based on the S&P 500, please know that it's not all sunshine and roses with what is in that fund. So in the S&P 500, as of August 2020, not all of the stocks were doing that great. And according to a CNBC article from that time, 62% of the companies in that index were actually in the losing range, while only 38% of companies were doing well or had recovered from some of the coronavirus downturn. So if you choose to invest in an index fund, know that it's not necessarily representative that the market is doing that great. In this example, I'm going to be talking about some of the kinds of bonds or bond funds you could buy, and also index funds that are based on the S&P 500, and going into a little bit more detail about the kinds of things that I look for if I was going to invest in some of these things. So this website that I'm showing here from treasurydirect.gov, it's pretty cool learning about the history of bonds. I'm not going to go through all of this, but you could see how savings bonds have evolved and what they were used for to help the United States government with some of its goals it had, and what bonds used to look like. And if we look today, we can see how treasury yields for US bonds have kind of decreased a lot over time. So these days, if you look at some of the current rates, and I look at what's most recent, and looking at things like the 10-year interest rate for US issued bonds, you could see that some of the rates are pretty low, at 10-year being 0.66%, 20-year being 1.19%, and the 30-year being at 1.4%. So if you lend your money to the US government for that amount of time, you may actually be at risk of losing money by loaning it to the US government based on if inflation is running at anywhere from 1 to 2%. So if you're willing to have your money locked up in bonds, it may not be very advantageous to you with interest rates at the low rates that they are nowadays. But some people do this anyway because bonds can be considered a cash equivalent, and there's some liquidity with selling them if the value of the US dollar goes down. Bonds could be used as a hedge to offset maybe any losses that people might have with the US dollar. But it's just something to think about as you may consider buying into bonds. And if you want to buy, say, Treasury bonds, these are what I consider kind of like US savings bonds. You could have a bond issued in terms of 20 years or 30 years. So in 20 or 30 years, that would be the maturity date. And you have to buy them in multiples of 100. And you could read more here about, if you buy the bond at a certain price, what the yield at auction would be compared to the interest coupon rate. So that's it for Treasury bonds. And similarly, there's something called Treasury bills or T-bills, which are also kind of like bonds, but they're more short term in that their terms can be only a few days to a year. So think about Treasury bills if that's something you're interested in. And again, this is an official US government website. And then if you're interested in something like a bond market ETF, you could look at something that Vanguard has, and you can see they also offer this in terms of a mutual fund. So you could consider that. But something to look at as you evaluate if buying a bond ETF would be helpful to you. You could see how the yield on this is at 1.19%. So it's something to think about. And then also look at what are the historical rates of returns. And although past performance is not a guarantee of future results, you can kind of see based on the return rates, you're kind of looking at since the beginning of this bond fund from 2007, it earned about 4.5% since that time. And something to think about are maybe there are some taxes to consider based on this bond. So the people managing this ETF, they may be buying and selling some bonds, and that could be subjected to taxes. So you want to think about what might be some of your end returns after a lot of the transaction costs or taxes there have been in this particular ETF bond fund. And then moving on to stock market based funds, I've invested previously in S&P 500 base index funds. And you can see based on this website what the components of the S&P 500 are and what the weightings tend to be for them. So something like Apple, Microsoft, Amazon, Facebook, Google, or Alphabet take up some of the high amounts of market cap in the S&P 500. So if you go down this list, you can see what are all the companies in the S&P 500. Moving on to some of the kinds of index funds or ETFs that are based on the S&P 500. You see here there's this Fidelity issued large cap index fund, which I think is loosely based on the S&P 500. And you can see here, it used to say no load like NL, but now it says NTF or no transaction fee, which is pretty important. That's something you want to look at. And you could see here how this has an expense ratio of 0%. So that's pretty awesome. That didn't always used to exist. So that kind of thing is something to consider as you look at if you think this kind of fund would be a good one to invest in. And if you check out the composition, you could look at if it matches what, say, the index usually is representative of. So you could see here in this one, it has about 516 holdings, over 502 issuers. So this is probably mostly based on the S&P 500, give or take maybe a few entities that may have left the index or joined the index. And you can see the makeup of this is the pretty big companies that we saw in the first list. And if you want to get an ETF version of that kind of fund, something to consider is the SPY or SPY. And again, I look at things like the expense ratio. So the expense ratio of this ETF is 0.09%. So that's something that I would consider, or maybe you want to look at its prospectus and holdings. So if you open this will open up a PDF that you could check out more details. And if we take a look at the Vanguard S&P 500 ETF, they also have a pretty good expense ratio of 0.03%. And some of the things that I take a look at is how the performance is over time, and also checking out the holdings. What does this ETF have? And you can see here they have 508 holdings, and as with some of the other funds, we can see some of the same top companies in this ETF. And Vanguard actually offers a similar index fund that had basically the similar components as the ETF, but this one charges a 0.04% expense ratio with a minimum investment of $3,000. So you can see that's a little bit of a difference. I don't pay attention to this risk potential. I don't know really what they're basing that on, so I don't pay attention to it. And then if you check out what the portfolio holdings are, you can see that this also has 508 holdings, just like Vanguard's ETF version of this. And last, if you take a look at Vanguard's funds, how they offer low-cost mutual funds and ETFs, you could see how expense ratios can make a big difference in your investments over time. And if you play around with this dial, you could see how, the more you grow your investments and the more you pay in expense ratios, like let's say the industry average might charge 0.5%. That can be a lot of money if you look at the gray bars here compared to if you might have considered opening the same fund at Vanguard. So just keep this in mind as you might consider buying into index funds or ETFs. If you enjoyed this video or learned something, please like and subscribe. And if you have questions, please leave them in the comments and I'll do my best to answer them. Thanks for watching. Till next time.